Hey, what's up, my friend? So, in today's episode, I want to share with you the top 5 beginners' mistake to avoid when trading the stock markets. Okay, so mistake number 1 is this, right? You want to avoid buying stocks in a downtrend. And here's why. According to a research, right, by Larry Connors, he has done extensive testing, right, in the stock markets. And stock above the 200-day moving average tend to have a positive median return. This means that stock above the 200-day moving average tends to continue moving higher. And likewise, right, when stock is below the 200-day moving average, the median return is negative. This means stocks below the 200-day moving average tends to continue moving lower. So this is why, right, you don't want to be buying stocks which are in a downtrend because it's likely to continue heading lower. Okay, so a very simple technique that you can apply is to only buy stocks when it's above the 200-day moving average. This ensures, right, that you are buying stocks which are in an uptrend. Mistake number 2, right, many new traders, they love to trade penny stocks, right? After all, that's where the big money is made, right? The stocks can, explode up 30, 40, 50, 100% within a few hours, a few days. But here's the thing about penny stocks, right? Is that number 1, there is low liquidity in this type of stocks. This means, right, that sometimes when you want to get out of the trade, you can't get out at the price you want because there's no seller at that price point or there's no buyer that's selling price, right? Depending whether you're long or short. And this could, cause you great problems, right? If you can't get out of a stock, right, that you want to get out of. And number 2, right, penny stock, they are easily manipulated because of their low liquidity, right? The price can, you can push it up really high, right? Few 100%, just like that, right? Because there is a low liquidity in this type of stocks. And when you chase, right, such a stock, guess what? This is when the stock's about to make a pullback. It's about to make a reversal. And the last thing you want to do is to be buying near at the absolute highs. So unless you are sure of what you are doing, don't trade penny stocks, especially when you're new to stock trading, right? Go with stocks, right, which are larger cap, like large cap stocks, right? Those stocks, it move slower. You have no more time to make your decisions, and you can get out of your trades, right? Buy and sell at pretty much any time that you want. All right. Number 3, don't buy laggards, right? So let me share with you, right? So in my early years of trading, right, I realized that in the Singapore market, the STI, it seems to be lagging the US stock market, and I was thinking, okay, that's a good thing, right? I should be buying more of the Straits Times Index, right? Because it's lagging to the US markets. And when it catch up, right, there's a huge, right, potential price increase, right, that I could profit from. And guess what? I bought the laggard and it stays a laggard for the next few years. So when a stock is a laggard, when a sector is in a laggard, there's a good reason for it usually. Okay, I recommend, right, if you want to trade stocks, if you want to trade like certain countries, indices, ETFs or whatever, focus on buying the stronger ones. Those are the ones that tend to outperform the market from a trading standpoint, right? If you buy the laggard, right, like what I did, right, in trading, it tends to remain a laggard, right, for the next few months, the next few years. Okay, so focus on buying strength, not weakness. Number 4, when you trade stocks, you don't want to take a huge position, right, into earnings, because the thing about earnings is that you have no idea whether the price of the stock will go up or down. Stock, right, it can go up on bad news. Stock, right, can go down on good news. How do you explain it? It's all about, perspective in the markets, right? It's all about people's beliefs and expectations in the market. Not just the news, right, but the expectations towards the news. And you can't predict, right, how people will react to that piece of news. So when you have a stock position, maybe a huge stock position coming into earnings, right, you don't want to be holding that stock position, right, into earnings, especially, it's something that, could really rattle the markets up and down, right? So be aware of it, right? Don't hold a huge position into earnings. If you want to hold position, fine, right? Trim it down to a very nice, comfortable level where you can sleep peacefully at night. And the 5th and final thing is that as a stock trader, you don't want to be buying during a bear market, right? This means that if the market is doing a recession, right, you don't want to be buying stocks. Why don't you just hold on to cash? As I've shared with you earlier, right? If the stock is in a downtrend, it tends to continue moving lower over time. And it's the same for the general stock markets. If the S&P 500 is in a downtrend, then guess what? Most stocks, right, tend to be in a downtrend. So it's better to hold on to cash, right, during such period. Make sense? So with that said, right, let's do a quick recap. Number 1, avoid buying stocks in a downtrend. Number 2, right, avoid trading penny stocks, right, focus on large cap stocks. Number 3, don't buy laggard, right, don't buy weak stocks, right, focus on buying strength. Number 4, don't take a huge position into earnings, right? Because you never know, right, how the earning results will turn out to be. or how the market will react to it. And the fifth and final thing is that don't trade or don't go long stocks during a bear market. It's much better, right, to hold on to cash or to trade some other markets altogether which are, more favorable to you. Alright, so with that said, I wish you good luck and good trading. I will talk to you soon.